Cisco just raised its own forward guidance by roughly $10 billion more than Wall Street had modeled, and traders sold the stock anyway. The same night the S&P 500 closed at a fresh record, doing the opposite of everybody else who merely met the number. Good morning. It's Thursday, August 13th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. Grab your coffee because Wednesday was one of those days where the index board and the individual scoreboard told two completely different stories. We'll walk through a cruel CP. I print that push stocks to fresh records, an AI infrastructure earnings night that makes Tuesdays look tame by comparison. Why the market keeps punishing good guidance the second it comes with a margin wrinkle, and what a deadly tanker strike and a record copper price are telling us about the supply chain heading into fall. First, though, the scoreboard. Eleanor, I believe this one opens with you.
I had a feeling it would.
You bet the Russell would give back Monday's whole round trip. And then some, if core CPI printed 0.2% or hotter yesterday morning. Core came in exactly there. 0.2 month over month. Trader fired.
It did. And then the Russell turned around and had its best day of the week anyway, up about 0.6%, the top performer on the board, while I was sitting here waiting for it to round trip into red.
Small caps didn't get the memo.
They didn't. I built that call around hot enough core matters more than the direction of the whole print. And what actually happened is the market read cooling in line, no scare, and bought everything, small caps included. Wrong mechanism, wrong result. Take the loss.
That drops you to 12 and 10 town, third loss in what's now a 3-game slide.
Third one stings more than the first two did.
Marcus, yours held up.
It did. And I built it better this time after Monday's Miss-Ames session call, no after-hours dodge. I said if CoreWeave didn't hedge its guide and Super Micro's margin held in that 15 to 17 range, the AI infrastructure group closes Wednesday higher, NVIDIA included, regardless of what CPI said. CoreWeave popped 19%. Nebius put up one of the loudest single-session moves I've seen in the space, and Super Micro matched it, stride for stride. Group closed up across the board.
That's a win. 12 and 10, and the streak flips positive 1 game out of negative territory.
Feels a lot better than 11 and 10 did yesterday.
Sarah and Dave are still on the bench, 0-1 and 0-2 respectively, waiting on their next shot in the chair. And a housekeeping note. Yesterday's calls, Eleanor's on the 10-year holding above 470, and Marcus is on Cisco confirming the AI infrastructure streak, are both calls about today's session, which hasn't happened yet at 5 a.m. pending, both graded tomorrow. On to the tape.
Wednesday's headline numbers actually look calm for once. S&P 500 up about 0.25% to 7,748, a fresh record close. Nasdaq led up about 0.5% to 26,588. Dow was the lone laggard, basically flat, down 0.04% to 53,770. And the Russell, as we just covered, up about 0.6 to 3045.
What actually drove it?
July CPI, and it landed about as clean as a print can land. Headline 3.4% year over year, down from 3.5 in June, up just 0.1 on the month. Core came in at 2.4% year over year, actually cooler than the 2.5 consensus, and up 0.2 month over month. No surprises, no internals worth worrying about. That took a market that had been genuinely weighing hike versus cut odds under Chair Warsh and moved it decisively toward the Fed just sitting still in September.
And the VIX told you exactly how much relief that was. Down about 5.5% to 14.45, its lowest close in weeks. That's not a market bracing for anything.
So where's the catch?
The catch is breadth. Nasdaq's strength was genuinely narrow. A handful of AI infrastructure names doing almost all the work, which we're about to get into. The Russell's gain was the more broad-based move of the day, and broad is usually the healthier signal. I'd rather see the cap-weighted index confirm what the equal weight and small cap tape are already saying than lead it.
Fair, but I'd add, narrow doesn't mean fake. When the narrow move is 3 separate AI infrastructure companies independently confirming the same demand story on the same night, that's a different kind of narrow than one stock running on hype.
And the 10-year, where'd that land? Since that's the thread we're actually grading tomorrow.
It eased about 2 basis points intraday down toward 4.68. Doesn't resolve my call. That's about whether it can hold below 4.7 by tonight's close, and we're not there yet. But it's a step in the right direction if you're the cooling data eventually wins camp.
Which brings us to the loudest story of the night, and it's not a subtle one.
It's not. CoreWeave, Nebius, and Super Micro all ripped Wednesday. CoreWeave's revenue came in at $2.6 billion, up 112% year over year, with adjusted operating margin at 5% against a 2.7% estimate. The margin inflection Eleanor and I were debating yesterday actually started showing up. Stock closed up 19%.
But the one everyone's talking about this morning is Nebius.
It is, and for good reason. Revenue of $582 million, up 454% year over year. But the number that matters is adjusted, EBITDA swinging to positive $236 million, from a $21 million loss a year ago. Annual recurring revenues at $3 billion, up from $1.9 billion in March, and they layered on a new compute deal with Reflection AI worth more than $1 billion through 2029, on top of the Microsoft and Meta contracts they already had. Stock closed up somewhere around 20%, touched even higher intraday.
Which is actually the answer to the question we spent half of yesterday's show debating: does the spending ever turn into a business? For Nebius, on this quarter, yes. That's a real answer, not another capacity announcement dressed up as one.
I hear a but coming.
There's a but. Their own capex plan for the year is $20 to $25 billion. Operating cash flow is nowhere close to that. Call it $1.3 billion. That gap, somewhere north of $19 billion, still has to come from somewhere external. New debt, prepayments, more equity. One profitable quarter doesn't retire that math. It just proves the business underneath it can eventually support it.
I push back on treating that gap as the scary part, though. It's leverage against contracted revenue. Microsoft, Meta, NVIDIA's own equity stake, now Reflection AI, not speculative revenue somebody's hoping shows up. That's a fundamentally different risk than what we were worried about with CoreWeave's backlog yesterday, where the customer concentration was murkier.
Give me the actual cash flow gap in one number, though, because it's contracted doesn't make the bill smaller. $19 billion plus still needs financing this year, on top of whatever CoreWeave still needs to raise for its own build-out. Add those two numbers together and you get a real sense of how much fresh capital this whole sector needs to raise in the next 12 months, regardless of how good any single earnings print looks.
And I think the market's telling you it's comfortable extending that credit. CoreWeave, Nebius, and Super Micro, all ripping the same night, on top of the financing deal we talked about Monday. Is capital markets voting with real money, that the demand is durable enough to fund?
So where do you two actually land on this? Is the debt-funded build-out the risk, or is it just what infrastructure financing always looks like at this stage?
I need to see a quarter or two where that capex to revenue gap actually narrows without another debt raise before I call it resolved. Right now, it's a really good quarter sitting on top of a financing question that hasn't gone anywhere.
And I think if the next raise prices at a reasonable rate against genuinely contracted revenue, that's the market answering the question in real time, and I'd bet on it doing exactly that.
We're not settling it today. Same as yesterday. Watch whether Nebius's next capex raise needs fresh debt, or whether operating cash flow itself starts closing more of that gap. If it needs another raise, Eleanor's closer to right. If the gap narrows organically, Marcus is.
I'll take that marker.
Same.
Quick human moment, because I need one after 2 rounds of balance sheet math before 8 a.m. My coffee's gone cold twice already this morning just from us talking.
That's the real casualty of earnings season.
Microwave it a third time. Live your truth.
Noted. Back to the tape, because the other AI infrastructure story from last night went the opposite direction, and is the more interesting one in some ways.
Cisco. They beat on both lines, revenue of $17.25 billion against a $16.82 billion estimate. Adjusted earnings of $1.22 a share against $1.17 expected.
So why does stock fall?
Margin. Adjusted gross margin compressed about 210 basis points, down to 66.3% as the mix shifted toward AI infrastructure hardware. Shares actually popped as much as 3% on the initial headline before reversing hard into the red down, somewhere in the 2 to 4% range after hours.
But look at what they raised guidance to. Full-year revenue of $72 to $73.4 billion, against a street estimate near $63 billion. EPS of $5.05 to $5.11, against a consensus around $4.28. That's not a timid raise. That's a company telling you next year blows the model up. and the tape sold it anyway on a margin line.
Which is the pattern, not the exception. Last night, Coherent beat on both lines too. $1.74 against $1.65 expected, revenue right at the number, and still fell about 4.5% after hours. Third time in 4 quarters a Coherent beat's been sold, after an 8% pre-earnings rally left no room for anyone to be surprised. And Cerebras actually missed revenue, $180 million against roughly $194 expected, even with core cloud revenue up 287% and raised full-year guidance, and that stock got hit hardest of the three, down 14 to 15%.
So it's not really about beat versus miss anymore.
It's not. It's the same shift we flagged last week, with Palantir getting rewarded and AMD, AppLovin, HubSpot, and Trade Desk getting punished for merely meeting guidance. Except now it's not even about the guide. Cisco and Coherent both beat and raised, and the market's punishing the margin line underneath the beat. The bar isn't beat and raise anymore. It's beat, raise, and don't scare me on where the profit's coming from.
I'll grant that's a real shift in what's getting rewarded this earnings season. I just don't think it changes the underlying story. AI infrastructure orders at Cisco hit $4 billion for the quarter, $9.3 billion for the year, and they raised their own AI revenue target to somewhere around $6.5 to $7 billion for next year. The demand's not in question. What's in question is whether investors will pay for growth that comes with thinner margins attached, and I think that's a much narrower worry than the stock reaction makes it look.
Setting up today, watch whether Cisco and Coherent stabilize into this session or extend last night's slide, and keep an eye on the networking and optical names trading in sympathy with both. Now, from earnings to something that should have moved markets and didn't.
2 things happened in the physical commodity world Wednesday that, on paper, should have pushed prices in opposite directions, and neither one did what you'd expect. Houthi fighters killed 4 crew and 2 rescuers in a strike on the cargo ship Tiama in the Bab el-Mandeb Strait, the first confirmed shipping deaths since the Iran war began back in late February. Hours later, U.S. Central Command fired 2 Hellfire missiles at the container ship Velanova in the Gulf of Oman after it defied the naval blockade, the 12th vessel struck since April.
And oil did what?
Basically nothing. WTI actually fell about 0.3% to 82.91. Brent was flat near 88.78. Real deaths, a real military strike, and the barrel shrugged.
Why?
Because the risk premium's already structurally embedded, not sitting there waiting to spike on the next headline. And there's a number behind that actually surprised me. Reporting this week put average daily crude flow through the Strait of Hormuz at under 5 million barrels a day in the second quarter, down from over 21 million barrels a day before the conflict started. That's not a market ignoring the risk. That's a market that already rerouted around it months ago. The next real shock isn't another tanker strike. It's OPEC Plus actually running out of room to add barrels. And by my read, that's 1, maybe 2 meetings away.
Meanwhile, the more interesting trade in commodities right now isn't oil at all. It's copper. London Metal Exchange price hit $14,000 a ton, a 2-month high, after COMEX set an outright record, $6.77 a pound earlier this month. That's a genuine physical squeeze, the Democratic Republic of Congo banning raw concentrate exports, plus a pending U.S. tariff decision that's already pulled over 200,000 tons into American ports in July alone, the largest monthly inflow on record.
Let me push on that, because a ban and a tariff scramble sound like supply-side noise, not proof that demand's actually stronger.
It's both, honestly. The DRC piece is supply-side, sure, but 200,000 tons of front-running into U.S. ports ahead of a tariff decision that hasn't even landed yet. That's real money. Betting real demand shows up on the other side, layered on top of actual AI data center electrification demand that isn't going anywhere. Supply shock and demand pull, same chart, same month.
I'd flagged the other side of that chart, though. Copper at a record is a rising input cost for every manufacturer and every data center builder out there, including, not coincidentally, the exact neocloud names we just spent 15 minutes debating the capex math on. A cost headwind doesn't cancel out the demand story Marcus is describing, but it does make an already tight financing picture a little tighter.
So watch the actual number. The White House's tariff call on copper imports is apparently the near-term swing factor for the metal either way.
That's the one to watch. It could go either direction fast.
Last stop before calls? What's actually on deck today? Because there's real data before the bell.
Jobless claims at 8:30, expected around 265,000 against 262,000 prior. Still historically low, but a move higher would be the first real crack in a labor market that's mostly held up. Same time, the Philadelphia Fed Manufacturing Index expected around -5 versus -12 last month. And the Producer Price Index also lands at 830, a soft PPI print after yesterday's cool CP. I would reinforce the disinflation story 2 days running, not just one.
Existing home sales and the leading economic indicators both land at 10, both expected to keep improving modestly. None of that's the story of the day, though. Applied Materials reports after the close tonight, and that's the one I'm actually watching.
Why that one specifically?
Because it's the picks and shovels layer underneath everything we've been discussing all morning. Consensus is around $3.39 a share on close to $9 billion in revenue, up about 23% year over year. Options markets are pricing a swing of up to 7% in either direction by the end of the week. If semiconductor equipment demand is still accelerating, that's AI capex confirmed all the way down the chain, not just the neoclouds, the actual machines that build the chips.
And I'd watch the same thing we watched with Cisco. Not just the beat, the margin commentary. If Applied Materials guides up on revenue but hedges anywhere on margin, given what happened to Cisco and Coherent last night, I don't think this market gives them the benefit of the doubt either.
Two-part test tonight then. Does the capex story hold at the equipment layer, and does it hold without a margin asterisk attached?
That's the whole night in one sentence.
Let's get to calls. For tomorrow, Friday, so we've got something fresh once today's data actually lands. Eleanor?
Buying some at 10-year. If today's PPI comes in soft and jobless claims don't spike, I think the 10-year finally breaks below 4.65 by Friday's close. Not just today's dip, an actual confirmation that Wednesday's CPI print started a real trend, not a one-day move.
Marcus.
Mine's on Applied Materials. If tonight's guide comes in above $9.2 billion for the current quarter, I think semiconductor equipment names gap up broadly on Friday, and it confirms the AI capex story, reaches all the way down to the equipment layer, not just the neoclouds and the chip designers everyone's already watching.
Two calls, two different layers of the same build-up. Eleanor's betting the macro data finally breaks the yield stalemate. Marcus is betting the capex story survives contact with the most unglamorous link in the chain. We'll know by tomorrow night. Here's where we actually are. A cool CPI print sent the S&P and Nasdaq to fresh records even as the 10-year refuses to fully cooperate. Nebius just proved the AI infrastructure spending story can turn into real profitability while CoreWeave and Super Micro backed up the same demand case. Cisco and Coherent both got sold on margin even after beating and raising. And the oil market's silence in the face of real violence says the risk premiums already baked in, copper, not crude, is where the physical story is actually moving. Watch this morning's PPI and claims. Watch Cisco and Coherent for signs of stabilizing or sliding further. And watch Applied Materials tonight for the last word on how far this capex story really reaches. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and you can catch live takes all day at Nova Ventures CEO on X. That's your Thursday morning brief. Have a great one, and we'll see you tomorrow.